So the yield curve is one of a large number of financial conditions that we actively monitor. It's not, there is no single financial condition that really dominates all the others, but that's one that we certainly do monitor. And I guess we know why, we kind of know why what short rates are doing. Short rates are really reflecting what they think the Fed's going to do. Really the question is what are longer rates saying? And they're saying a lot of different things. There's a term premium there, which is about risk on, risk off, that moves up and down in different states of sentiment, market sentiment. There's also some sort of an assessment, though, in there about what the neutral rate is in the longer run. And so we look carefully at that and try to see if we think policy is above the market's estimate of the neutral rate, then policy is tight. And so we have to sort of assess that. But, so when the curve is inverted, we focus very carefully on that. And it's not something that you need to deal with immediately, but it is something that it wouldn't be comfortable to be in that state of affairs for an extended period of time, of course. But again, it's one of many conditions. I hope that's what I said last year, by the way.
I think so. All right. I think so. All right. So the Fed has consistently characterized inflation as too low. Given that core CPI is at the highest level since 2008, and the Fed's preferred measure, core PCE, the 6-month annualized rate is above 2%, do you anticipate changing your assessment of inflation?
I would like to change my assessment of inflation. I would like to see it move symmetrically around 2%. And in PCE and core PCE terms, it still hasn't done that. We've seen it. Take core PCE, which is a better indicator of future inflation than regular PCE, although regular PCE is, of course, our goal. So you take core inflation, it's moved up and just kind of touched 2% and then moved back down to well below 2% in the first quarter of this year. It's now moving back up. I guess the real question is, why do we care? It's essentially, it appears to be centered a few tenths below 2%. And the reason we care is not that 2 or 3 tenths of inflation really makes a big difference. The issue is more the broader context. We want inflation expectations to be centered right at 2%, and we really want to hammer that point and make sure that they are. Because we look around the world and we see disinflationary forces in Japan and Western Europe, where you see inflation moving down, expectations move down, inflation moves down, and it's been very, very hard for economies to get off that road once they're on it. So we don't want to get on that road. We don't think we're going to be exempt to these disinflationary pressures over time. We've got an aging population, as others do. I think some of the same characteristics to our economy. So for that reason, we want to keep inflation at 2%. And it's not easy to explain that to the general public who don't really care whether inflation is 1.7 or 2%. But in our case, we think to serve them better, we need to anchor inflation at 2% so that it doesn't begin that inexorable slide down.
So when you come in to the office every day or as you travel through your day-to-day life, I am curious what your dashboard looks like. What are you looking at on your dashboard to give you an indication of where your ship is or your plane is heading? So are you looking at, you mentioned industrial production, you mentioned productivity, inflation. Are there external factors like rest of world growth indicators? What are the things that are your touchstones that are most important on your dashboard?
It's there's a lot of things on the dashboard, I would say. I try to do a deep dive on the economy. Mostly every weekend, I'll spend a whole day reading everything that I haven't been able to read during the week about what's going on in the U.S. economy, and that means reading the data releases and the analysis of the data releases by many of you here in this room, and also around the world, also globally, following data and following markets and that kind of thing. So that's the kind of thing you can do on a long, quiet day when you don't have meetings all day long. So that's a big part of it. I also think right now the broader sort of geopolitical risks are important right now, And you have to be watching those carefully and trying to assess the implication of those. I watch markets very carefully. I have a screen in my office where I don't sit there watching it all day, but you check in several times a day to look at what's happening in all the various markets that we all probably follow. So it's essentially, I look at everything in a way, and as I imagine many of us do.